Welcome back to Stock Trader School, from rookie to Rainmaker, and this is Wall Street Walkthrough. Today's subject is the Clearinghouse, where every trade is finalized. Your trade isn't done when you click buy, it's done when the Clearinghouse says it is. Mouse clicks, by flash, unseen servers process trades. Digital beep, hum of servers, and electric static. Are you okay? A clearinghouse sits at the center of the financial system between Wall Street and your phone. And their job is simple: make sure every trade actually clears. So in this episode, we show you what actually happens when you hit buy. This week on Wall Street Walkthrough, we explain how clearinghouses guarantee the settlement of securities trades. First, Joe sends his order to his broker-dealer, Charles Schwab. Remember, counterparty risk is the risk that the other guy won't pony up when it's time to deliver. You wouldn't want to give your money to someone who then runs off to the Bahamas with it, and then you never get your stock. And you definitely don't want to give your stock to someone who then doesn't give you the money, and then you're holding the bag. But these things happen all the time, and the reason they don't happen today is each step in the process requires labor, technology, and office space. So naturally, these costs are passed along to traders. At every level of the food chain, clearinghouses are the reason why trades take time and cost money. They ensure that the proper number of shares and dollars are delivered to all parties involved. Knowing how and why trades clear lets you better understand fill latency, margin timing, and fund availability. They guarantee transactions by removing counterparty risk. All big players clear their trades through central clearinghouses like DTC or OCC and see what happens after the trade. Every solid trade stands on invisible scaffolding. Clearinghouses make it all work. So if you want to see what holds up the entire global financial system, clearinghouses add friction and cost to the system, but they prevent systemic risk and failure. Markets would completely collapse without clearinghouses. And knowing how and why trades clear gives you a huge advantage as a trader. All of these factors impact your ability to execute trades. And understanding the system helps you improve your edge. Think of clearinghouses as the referees of the financial system. They enforce the rules and penalize bad behavior. Remember the 2008 financial crisis? Well, one of the main reasons that it happened was because clearinghouses failed to penalize bad behavior. By not enforcing margin calls, clearinghouses allowed excessive leverage to build up in the system. When the music stopped, everyone defaulted and the clearinghouses failed. Today, clearinghouses have much tighter rules and capital requirements to avoid a repeat of the crisis. Because there's a clearinghouse standing between each party to make sure that both sides get what they expected. A rogue trader at a large bank executed a massive sell order for $400 million worth of E-mini S&P futures. This crashed futures prices by 20% in a matter of minutes. After the trade, the clearinghouse absorbed the loss from the trader's defaulted account. This saved the exchange from total collapse. Can you imagine what would happen if there was no clearinghouse? Everyone would scramble to exit their positions before they become worthless. Markets would completely collapse. Clearinghouses prevent this from happening. They allow traders to unwind positions without fear of complete systemic failure. The clearinghouse eliminates counterparty risk because they stand between buyers and sellers. For example, let's say you bought a stock on margin through Fidelity. Fidelity executes your trade on the exchange, but they don't actually settle the transaction until the next day. That's because they send their trades to DTC for clearing and settlement. DTC then sends Fidelity their daily report, which includes all of their cleared trades. DTC acts as a central counterparty for most U.S. equity trades. Other clearinghouses like OCC handle over-the-counter options and futures. So yes, clearing is required for almost every trade. By guaranteeing transactions, clearinghouses allow for more trust in the system. Buyers know they'll receive their stock regardless of the seller's solvency, and sellers know they'll be paid regardless of the buyer's solvency. Then Schwab sends Joe's order to the clearinghouse, which matches it with Sarah's sell order. Finally, the clearinghouse confirms both trades and settles the transaction by transferring funds and securities. Boom! Done deal. The clearinghouse acts like a creditworthy sponge. Instead of saying I owe you, they say you owe me. Every step in the clearing process adds some amount of latency to the system. So the more steps you add, the slower your trade fills. When you place a market order, your broker-dealer routes your order to a designated market maker. They execute your order and deliver the shares immediately, but they don't actually collect payment for those shares until the next day during the clearing process. So if you buy 100 shares of Apple at market on Monday, you'll see the shares hit your account on Monday, but you won't actually be charged until Tuesday. This is called a delayed fill. They take on the risk of collecting money from one party and delivering the stock to another. If either party defaults, the clearinghouse absorbs the loss from their collateral. This way, neither party can default without first losing their collateral to the clearinghouse. In the event of a default, the clearinghouse covers the shortfall and delivers the product. Without them, the entire global financial system would grind to a halt. The clearinghouse matches up your order with another trader and guarantees that both parties will get what they expect, even if one party defaults. This function is called clearing and settling. In finance, we typically combine these into one word, clearing, which means the exchange of contracts and cash for a security. A clearinghouse is the middleman to the middlemen. In this example, Trader Joe wants to buy 100 shares of Apple from Trader Sarah. Clearinghouses reduce systemic risk because they remove counterparty credit risk from trades. So now you're probably wondering, why do we need a clearinghouse at all? Well, think about it this way. Who uses clearinghouses? Almost everyone. Broker-dealers, banks, and exchanges like NASDAQ and the New York Stock Exchange clear trades through central clearinghouses like DTCC and OCC. So why should retail traders care? Well, clearinghouses remove counterparty risk and guarantee trade settlement, but they add friction to the system. Clearing also adds cost. So why do we use them? Because the alternative is chaos. Clearinghouses protect against systemic failure. Do you remember the flash crash of 2010? But that's not all they do. Clearinghouses also handle corporate actions like mergers and acquisitions, stock splits, and dividends. And that brings us to why it matters. If a clearinghouse fails, markets collapse. We're done for this topic for today. Let's summarize. A clearinghouse is the middleman to the middlemen. Thank you for watching. We hope you enjoyed this episode of Wall Street Walkthrough. Every solid trade stands on invisible scaffolding, and clearinghouses make it all work. Know the system, and you'll know the game. Catch you Wednesday. If you did, please hit like and subscribe.